Gasoline costs about 30% more than it did a year ago. Diesel, the fuel that moves everything you own, is near its all-time record. And nobody at the Federal Reserve can do a thing about either one. Not because they're bad at their jobs, because interest rates don't drill oil. I filled up on Tuesday, 14 gallons, 57 bucks. A year ago, that same tank was $44. And here's what most people haven't connected. The gas, the grocery bill, the mortgage rate that somehow went up after the Fed cut, that isn't three separate problems. It's one problem, it has a very specific shape, and the last time it had this shape, Richard Nixon was president. This isn't a story about inflation. It's a story about what happens to the price of everything you own when the last 40 years stop being the rule. There are three traps in that story. Two already caught people this year, including one trade that's down 43% while everybody called it the safe one. My name is Nick, and I've spent an unreasonable share of my adult life reading about a decade I wasn't alive for. If you've ever felt like you're doing everything right with money and still sliding backwards, hit subscribe. We're walking all three traps, and somewhere in the middle I'll show you the one number almost nobody is checking. I'm not a financial advisor, and this isn't financial advice. I have no idea what happens next, nobody does, but I know what already happened. So let's go back. Sunday evening, August 15th, 1971, Richard Nixon goes on national television and tells the country he has directed the Treasury Secretary to temporarily suspend the dollar's convertibility into gold. Temporarily, that was 55 years ago. Sit with how load-bearing that word turned out to be. Until that Sunday, a dollar was a claim check. $35, 1 ounce of gold, and foreign governments could cash it in. After that Sunday, a dollar was a promise. Same paper. Completely different product. In the same speech, Nixon froze all wages and all prices in America, the first peacetime price controls in the country's history. The plan was to inform businesses how much they'd be allowed to charge, as though inflation were something you could talk out of happening. It went about how you'd expect. In the summer of 1973, ranchers stopped shipping cattle rather than sell at the capped price. Farmers drowned their own chickens. Shoppers stripped the shelves. You cannot fix a shortage by making it illegal to charge more for the thing that's short. Then, on October 19th, 1973, OPEC announced an embargo. Oil went from $2.90 a barrel to $11.65 by January, up 300% in about 90 days. Gas lines. Rationing. A national speed limit. That's the part everyone tells you, the History Channel version. Here's the part nobody does, because the interesting question isn't what happened to the country. It's what happened to a family. So let me introduce you to one. A household I'll call the Rileys, a composite, but every number attached to them is real. Ed and Marion Riley, Dayton, Ohio, married in 1966. He's at the GM plant, she keeps the books at a dental office. In 1971, they're pulling in about $10,400 a year, a hair above the American median. By every measure anybody used at the time, they're doing fine. Watch what the next 10 years do to them. Trap 1, the safe money inflation hit 12.3% in December of 1974. Then it did the thing nobody expects. It went away for a couple of years, everybody relaxed, and then it came back and hit 14.8% in March of 1980. Still the post-war record. From 1971 to 1981, cumulative inflation ran 124%. So a dollar the Rileys tucked away in 1971 bought 45 cents of groceries by 1981. Hold it to 1991, 30 cents. Obviously, you don't leave it in a drawer, you put it in the bank like they did. Over the 1970s, treasury bills, the safest thing in the world, the thing your savings rate is built on, returned about 84% while prices rose 104%. Safe money lost roughly 10% of what it could buy, and not in one bad year, T-bills lost to inflation every single year from 1973 through 1980, with one exception. Here's the part that gets left out. A federal rule called Regulation Q made it illegal for Marion's bank to pay her more than a set rate. The official position was that consumers needed protecting from earning too much interest. Truly heroic work. Fine, you say. Stocks, the S&P 500 fell 48% between January 1973 and October 1974. Of the 318 growth funds that existed then, 313 lost money. But the crash isn't the punchline. This is. On February 9th, 1966, the year Ed and Marion got married, the Dow closed at 995. On the last trading day of 1982, it closed at 1,046, 16 years and 10 months. A 5% gain, while consumer prices tripled. And yes, that's price only, dividends mattered enormously back then. So here's the honest number. From 1966 through 1982, with every dividend reinvested after inflation, the S&P 500 returned zero, not a little, zero for 17 years. Now here's where it gets personal for the Rileys, and where almost everybody tells this story wrong. They bought their house in 1971. $25,200, 20% down, 7.5% for 30 years. $142 a month, about a sixth of what they brought home. 10 years later, that payment is still $142, and their income has roughly doubled. Inflation, the thing eating their savings account, was quietly paying off their house. That's the one place an ordinary family came out ahead in the entire decade, and it happened by accident. Their daughter got the other side of it. She buys in 1981. Same kind of house, same suburb. $68,900, which sounds enormous until you notice it's still about 3 times median family income. The same multiple her parents paid, the rate is what changed. At the October 1981 peak of 18.63%, still the all-time record. She's paying $859 a month, 46% of a median family's gross income. Same house, same multiple of income, and it went from a sixth of a paycheck to nearly half. It was never a price shock, it was a rate shock. And here's what 46% looks like. Because a percentage is a statistic, and that was somebody's life. The thermostat at 62 and the kids told to put on a sweater, a second job you describe as temporary for 4 years, the vacation quietly becoming a weekend at your sister's, and then not happening and nobody ever announcing that it stopped. That's trap 1. Savers lost, buyers got flattened, and anybody in the stock market ran in place for 17 years. While median family income in 1982 bought about 10% less than it did in 1973. Which means the obvious move, the one everybody now says they'd have made, was gold. Let me show you how that went. Trap 2, the crowded trade, August 1971. Gold is $35 an ounce. January 21st, 1980, it fixes in London at $850, 24 times your money. About 40% a year for 9 straight years. If you bought at the gold window and sold that morning, you were the smartest person at every dinner party in America, and you'd earned it. And then, gold fell for basically 20 years. It bottomed around $253 in 1999, down about 70% in plain dollars. Closer to 85% once you adjust for the inflation it was supposedly protecting you from. It didn't recover that January 1980 purchasing power until roughly 2025. 45 years. That's not an investment horizon, that's a life sentence with an ounce of metal. And it wasn't only gold. By 1980, 7 of the 10 largest companies in America were oil and gas. 8 years earlier, only 2 had been. Today, energy is under 3% of the market. So here's the rule from the 70s, and it isn't the one you usually hear. The winner of a crisis is almost always the most crowded trade at the end of it. It doesn't stop working because it was a bad idea. It stops working because by the time everyone agrees it works, everyone already owns it. Hold on to that, because in 2026, we just watched a speed run of it. Now today, and I'll go fast, because the parallels are almost annoyingly on the nose. February 28th, 2026, the United States and Israel strike Iran. Iran closes the Strait of Hormuz, the channel that carries roughly a fifth of the world's seaborne oil. Daily transits go from about 130 to nearly zero. That first week, West Texas crude rose 35%, the largest weekly gain since oil futures began trading in 1983. Brent peaked at 126 in April, and it's still up about 29% on the year. That's your 1973. Different flag, same choke point, same result, and on the ground it looks like a guy with a 30-mile commute finding out his drive to work now costs him a car payment. Now the money side. The national debt is $39.8 trillion and crosses 40 trillion in days. It's growing at $1,549 per second. So about $1.5 million got added while I read you that sentence. There goes another 100 grand. But the debt isn't the scary number. This is interest on it runs about $1 trillion a year higher as a share of the economy than at any point since World War II. It's now the third largest line item in the federal budget, behind only Social Security and Medicare. America spends more servicing its debt than on its entire military. $3 billion a day, and none of it builds anything you can stand next to. Then there's the Fed. Powell wasn't reappointed, Kevin Warsh took over as chair in May, and in July that committee voted 9-3 to hold rates, with the three dissenters arguing for a hike. Days later, payrolls came in at negative 23,000 jobs. That's the trap in one sentence. Supply-side inflation that rate cuts can't fix, sitting on a job market that rate hikes would break. It's the exact box Arthur Burns was in, and Burns got leaned on by Nixon to keep money loose into the 1972 election. We know because it's on tape. Researchers have since priced what that pressure costs. Pure inflation, no growth, you just get the bill. And underneath all of it, the number that should bother you most, real average hourly earnings are negative over the past year. Wages up 3.2%, prices up 3.4%. Your raise was a rounding error with extra steps, which is usually when somebody says, fine, I'll just buy gold. So let's check the scoreboard. Gold rose 65% in 2025, its sharpest gain since 1979, which feels thematically appropriate. Silver rose 144%, its best year since, again, 1979. Everybody noticed. The stories ran. The ads ran. Money poured in. Gold peaked around $5,600 an ounce on January 28th of this year. Today it's about $4,650, down roughly 17% in 7 months. Silver peaked near $121 in January. It's around $69 now, a 43% drawdown. This year in the asset everybody agreed was the answer. Gold spent 2025 doing exactly what the brochure promised. Then in January, it read the brochure back to everyone who just bought it. So the crowd bought the 1970s playbook in January at the top and lived a compressed 20-year gold chart in 7 months. That's what chasing the last crisis's winner feels like from the inside. It doesn't feel reckless, it feels obvious. It feels like you finally learned the lesson of history. Meanwhile, the things that actually worked were boring, copper at record highs, and energy stocks up around 45%. That's trap 2, sprung in real time. Trap 3, the price, and this one should actually worry you because it has nothing to do with oil. Go back to the end of the story. August 12th, 1982, the S&P 500 closes at 102, trading at about 8 times earnings, 6.5 times its 10-year inflation-adjusted earnings, and paying a dividend yield of 6.24%. Read that again. You could buy the entire American stock market and get paid 6% a year in cash just to hold it. 3 years earlier, Businessweek ran a cover story called The Death of Equities. 7 million shareholders had abandoned the market since 1970, and the magazine concluded the country probably has to regard the death of equities as a near-permanent condition. 36 months later, the greatest bull market in history began. From that August 1982 low through the year 2000, the S&P returned roughly 20% a year for 17 straight years. So, and this is the actual thesis of this video, the once-in-50 years event was never the inflation. Inflation was the mechanism. The event was the repricing. 17 miserable years handed you the cheapest stock market since the Depression, and that price paid for everything after. Now compare it to what's in front of you. Remember the number I said nobody's checking? Here it is. The S&P 500 currently trades at about 41 times its 10-year inflation adjusted earnings, higher than in all but about 18 months of recorded history, all of them in 1999 and 2000. And the dividend yield is 1.05%, an all-time record low. Your index fund now pays you less than a savings account your bank would be embarrassed to advertise. 6.24% then, 1.05% now. Same country, same index, opposite decade. And it's concentrated. The 10 largest companies are around 38% of the index, the Magnificent Seven alone about 34. The previous record was 1970 at 28. Back then, the crowd favorite was Polaroid at 95 times earnings, a company whose entire business model was that photographs would always need paper. It fell over 90%. The business wasn't the problem. The entry price was. So, the 1970s setup arriving at a stock market priced like 1999. So, is it happening again? Yes, just not the part you were told to watch. Now let me argue against myself, which is either intellectual honesty or a cry for help. Start with the most important. There's a market gauge of what investors expect inflation to average over the 5 years starting 5 years from now. It's 2.32% today. A year ago, 2.34, it hasn't moved 2 basis points in 12 months, while actual inflation ran up to 4.2 and back down. In 1979, that same number was near double digits. The 70s were fundamentally an expectations failure. People stopped believing prices would ever settle and started acting accordingly. That hasn't happened. Second, there's no wage price spiral because there's nothing left to spiral. Private sector union membership is under 6%. In the 70s, it was a quarter of the workforce, with cost of living raises written into contracts. That machinery is gone, bad news for workers, good news for inflation, and I'd love a cheerful way to say that. Third, America produces its own oil now. In 1973, we imported a third of ours and were negotiating from our knees. Today, expensive oil is mostly a transfer within the economy instead of out of it. And core inflation is 2.5% and falling, with unemployment at 4.1. In 1975, it was 9. Whatever this is, it isn't the 70s yet, and anyone telling you otherwise is selling something. Usually the thing that's down 43%. So which is it? Here's what I actually think. Anyone who tells you they know is guessing with confidence, which is the most expensive thing a person can do with money. The useful question isn't is this the 70s, it's what would have to be true for me to be fine either way, and I know the objection, because I'd have it too. You're 28, you've got $400 a month going into a target date fund, and some guy on the internet is talking about cyclically adjusted earnings multiples. What does this have to do with you? More than you'd think, and not in the direction you're bracing for. If you're 28, you're a net buyer of stocks for 30 more years. And every dollar you put in gets priced at whatever the market decides to charge you. So a long, ugly, sideways decade isn't the thing that ruins you, it's the thing that makes you. The worst outcome for a 28-year-old isn't a crash, it's 40 more years of expensive markets and never getting a discount. If you're 58, flip it. You're a net seller inside a decade, without 17 years to wait out a flat market. Not a reason to panic, a reason to know exactly how many years of spending you've got parked in something that isn't stocks. Same facts. Opposite instructions. Almost nobody says which one they're talking to. Now the last number because it changed how I think about all of this. Back to the Rileys. They started putting $100 a month into the stock market in 1966, and we'll pretend they could just buy the whole market, which, small detail, ordinary people couldn't do until 1976. Before that, diversification mostly meant owning 2 different kinds of bank. They kept going. Through the 48% crash, through the gas lines, the price controls, the chickens, through August 1979, when the country's biggest business magazine told them on its cover that what they were doing was dead. By the end of 1982, they'd put in $20,400. It was worth about $45,800, which sounds fine. until you adjust for inflation and find a real gain of roughly 8%. 8. Over 17 years of never missing a month. I won't dress that up, it's a bleak result, and if Ed had quit in 1979, nobody would have blamed him. But he didn't, and after 1982, they never added another dollar, they just left it alone. That 45,000 untouched from 1983 through 1999 became roughly $804,000. 17 years of nothing bought 17 years of everything, but only for the people still standing there. And that's the real lesson here. Nobody got rich in 1982 because they predicted 1982. They got rich because they kept buying something boring while it did absolutely nothing, and quietly accumulated cheap shares during the exact years everyone else was explaining why stocks were finished. So let me give you permission to do something radical. Stop trying to call it. You can't control oil. You can't control the Fed. And at this point, neither can the Fed. You can't control whether the market is at 40 one-times earnings or 7. But 3 things you can control matter more than any forecast. How much you save. Whether you're ever forced to sell at the bottom, which mostly means holding enough cash that a bad month isn't a liquidation event, and what you're willing to pay. That last one is the whole video. When this story ends, and it will, they always do. The people who come out of it well won't be the ones who saw it coming. They'll be the ones who still had money and the nerve to spend it on the day the magazine said not to. 3 traps. The safe money that quietly loses, the crowded trade that already won, and the price you're paying while everybody argues about the other 2. Tell me where you land. Does this rhyme with 1973, or is the comparison nonsense? I'd rather be argued with than agreed with. And if this was useful, send it to somebody who's been quietly worried about money and hasn't said so out loud. I'll see you in the next one.